Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, February the 24th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement in your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Some economic data that we got out today. Flash PMI came in at 49.8, was expected 53.4. So anything below 50 is a sign of recessionary or contraction in the economy. So that's going to be really interesting to see how the ISM PMI comes out. But it was expected at 53.4. So they were expecting a little bit of expansion, but we got a contraction. New home sales came in at 494,000, was expected 522,000. So if you remember, yesterday we had existing home sales came in a lot better than expected. Today we have new home sales coming in much lower than expected. We also had the DOE, which is the Department of Energy's crude oil inventories come out. They came out with 3.5 million barrel build versus a 2 million barrel build. The interesting thing about that is crude oil is actually rallying off that number. The reason why is because we got API last night and it came out at 7 million barrel build. So the DOE is the one that really most people will look at, and because it was less of a build than what the API showed, crude oil inventories or crude oil is starting to rally. A couple of interesting notes about that. We also had petroleum was petroleum demand, gasoline demand rose about 5.2% compared to last year. And we also had distillates, which was the demand was down by 16% versus last year. Now the distillates, the difference between the distillates and the gasoline is the distillates is what goes into like manufacturing different kinds of solvents and stuff like that. So that's pretty important. Despite the fact that we're using more gas and gas demand is going up, it's probably due in part to that gas is such, below $2 around the nation, and at around $1.50 in most places. So keeping that in mind, gasoline is going higher because people are taking advantage of that low-cost gasoline. But where distillates goes into the manufacturing process of a lot of products is really tumbling. So that is important because it seems that manufacturers aren't producing as much and using those distillates. So keep that in mind going forward. But as you can see right now, it looks like crude oil is at the high of the day and still in negative territory, but pushing to the high of the day. Moving on to the overall equities. With this crude oil rally, equities are rallying as well, coming off of their lows. Nasdaq earlier today was down well over 60 some odd points, I think even. Last I checked just a few minutes ago before I went online, it was down about 51 points. We're down to down only 30 points on the day. It's a little weird that in my eyes that we are really so attached to what direction crude oil is moving. The overall economy should like this lower gas prices, and so if gas prices start rallying, it should actually hurt the overall economy, other than the Balkan oil fields and those jobs there. But everything from transportation and transportation costs for these different companies is going to be lower when gas prices are lower. So that would be good, not necessarily bad for them. Moving on to the E-mini S&Ps /ES, we're only down about 13 points now. We were down, touching this 1886 area. So looking at about 25 points lower. So we were down about 38 points earlier on, and now starting to rally up. On the chart here, as you can see, what I was talking about, we were coming down and testing this value area low before I started getting ready for this, and we have had a massive rally up and breaking through the 1900 level, only down about 13 points right now on the E-mini S&P/ES, as you can see here. So overall markets are really pushing higher. And with JP Morgan, this is pretty interesting. When I started trading this morning, the markets opened, this was just a free fall to the downside, so I decided to cover my JP Morgan, and I had on the March 62.5 call spread. I originally sold it for 81 cents, bought it back for 17 cents this morning. And if you remember yesterday, I covered my Goldman Sachs. It's just a little bit worried about the overall banking sector and thinking that it was going to push a lot lower. So I covered my Goldman Sachs yesterday, which is GS, and covered my JP Morgan, which is JPM, ticker symbol there. Moving on to McDonald's. I did cover my McDonald's yesterday, and that chart should be down here somewhere. And with McDonald's, I covered this yesterday towards the end of the day. I was thinking when I was coming on here, you'd be able to cover this a little bit better, but now that's a little bit suspect with the implied volatility starting to rally here. But in McDonald's, I covered my March 110 puts for 53 cents and originally collected $1.06 for that trade. So I got 50% of my max profit on that. Went a little bit over on my JP Morgan for my max profit target, and that was because I had that on as a pairs trade with Goldman Sachs. So didn't quite get my 50% of max profit with Goldman Sachs. Covered it a little bit late, if you will, and then covered my JP Morgan a little bit late as well, and got well over 50% of my max profit on that. So that's about all I got for you guys today. The iron condors are still in effect. It's going to take a while for those to really start seeing some of that decay come out of it, just for the nature of having the calls and the puts. It takes a little bit longer to see that profit potential come into line. And Friday's webinar is going to be on iron butterflies, so it's going to be a little bit more risk and a little bit more reward if we're correct on those. And then the next Friday, we're going to wrap this all up with a how you defend these type of strategies when they start going against you. So keep your eyes out for that one. Go to protraderstrategies.com and sign up for that. That's all I got for you today, other than if you can't take that, take it easy.